Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, February 15th, 2025. Hey, how you doing? I hope you're all doing well. I hope you had a good week of trading. I hope you are enjoying your weekend. Um, and I hope the podcast today is going to be helpful for you, and I just appreciate you coming by and spending your time. This is my final day in Colombia, and took a picture here. Just wanted to share it with you of my beautiful girlfriend Christina and our dog Sky. And it's a bit of a sad day because I am going back to the States today after 3 months in Colombia. I just really enjoyed my time here with my girlfriend and my dog and the beautiful weather. And so I'm heading back to Utah into the cold, into the snow. And so I'm a little apprehensive and sad to travel today. But just wanted to get the podcast done and out of the way and then enjoy the last day with my girlfriend and the beautiful weather. So, um, like I said, appreciate you being here in the with the podcast. And the format of the podcast today is as follows. First of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back and take a look at all the positions and all the trades that I made last week, and I'll explain when I entered the trade, why I entered the trade, what the thinking was, what the setups were, what the confluences of signals were, where I entered, how I position size, where I'm going to place my emergency stop, where I'm going to place my end of day stop, how I am going to take partial profits if the trade goes my way, how I'm going to get into trailing stop mode, and then ultimately how I am going to exit the trade. So we'll talk about when I entered, why I entered, and how I am going to manage the trade going forward. It's a really good week for me. Not all winning trades, but rarely do I have a week where they're all winning trades, but the winning trades were bigger than losing trades, and that's all that matters. And I've got some good examples for you of some good trades. And after that, we're going to talk a little bit about trader psychology. Most important skill in trading, the ability to create a plan, follow the plan. That's it. That's the difference between the traders that make it and the ones that don't. It's not the plan. There's plenty of good trading approaches out there. Whether you learn them from me or from someone else, it doesn't matter. The key is, can you follow them? That's really the key. I say this every week, but I'm just trying to drive this home to you. Whatever it takes to follow your plan, get that done, and you'll have a successful trading career. If not, you're going to have challenges. I promise you. After that, I have gone down through my watch list, my master watch list, both on the daily time frames and the weekly time frames. I do it every Friday night. I have gone through and I have identified some potential trades for next week on both time frames. Now, they're not where they need to be yet, but if they do get there, I will consider taking the trade, because wherever there is a confluence and a good location to potentially take a trade. It doesn't matter. It doesn't mean that if it gets there and I take the trade, it's going to be a winner. Far from. But, we trade in probabilities, and I think I'm comfortable in saying if they get to that location, there's a better chance they'll go my way than they'll go against me. And that's really all that matters. So I hope you're going to find this helpful, how I'm managing and how I entered my current trades, and then what I'm looking for next week. And if you do find it helpful, I really would appreciate if you could hit the thumbs button on the YouTube channel. It helps the algorithm know that people like the content, they found it valuable, and it just helps keep the podcast around and lets YouTube get it out to more people. So I would certainly appreciate that. So let's go ahead, run the U.S. legal disclaimer, get that out of the way, and then we'll come back and we'll get started. Hang tight.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Okay, so let's get started here on the current positions that I'm in. And on the first one, I'll go into a little bit more detail of exactly how I set things up. And then going forward, I won't go into as much detail. But let's start with IWM. So I trade 7 different trading approaches, and you'll see multiple different trading approaches in the positions that I have here today. But this particular one, IWM, is what is called the strategy is called a deep dip buy, and you see me use this quite a lot. I use it. I teach it, and it works well. It's one of my very favorite ones. But let's start here. This is IWM Russell 2000. So I got long the Russell 2000 on the 13th of January at $217.40. So the first question is, why did I get long? Well, being that it's a deep dip buy, a deep dip buy involves either the 200-day moving average, which is the black line, the 250-day moving average, which is the purple line, the 300-day moving average, which is the orange line, and or a 30 RSI rejection. So on the day that I entered IWM here, the 13th, we had an intraday rejection of the 200-day moving average. This is the black line. You can see during the day, we went below it and closed back above it. When it comes to my trading, I generally wait until the end of the day to make my buying or selling decisions. And on the deep dip buy, I certainly wait. I want to see prices bounce at the 200-day moving average, close under, close over, or in this case, intraday rejection where it went below, close back above. So that by itself, that intraday rejection by itself is a legitimate entry. But on top of that, we also had what is called the V1. The V1 consists of 2 bars, bar 1, bar 2. Bar 2, you can see, went under bar 1's low, closed above bar 1's close. So that was the confluence. I really look for confluences in my trading, confluences of signals when I take my entry. So we had an intraday rejection of the 200-day moving average and a V1. So I got long at 217.40. So the question is, when I get long, how much do I buy? It's very important. So I repeat this every single weekend. There are 2 components to figuring out how many shares I'm going to buy. The first component is how much do I have in my trading account. The second component is what is the value of the 2 ATR. So let's just today use a hypothetical $50,000 trading account. I take 1% of my trading account. Doesn't matter if it's 50,000 or 5 million, but let's just say 50,000. 1% of that is $500. Okay, so I take 1% of my trading account, whatever that number is, divide that then by the value of the 2 ATR. The 2 ATR is 643 divided by 643. So if I had a $50,000 trading account and the 2 ATR was 643, the proper amount is 77.7 shares. I just round that up to 78 shares. So if you have 100,000, it's 1,000 divided by the value. But it's using the 2 ATR, that helps you account for the volatility. If the volatility is higher, that number is going to be larger. And if that number is larger, you're going to buy fewer shares. If the number is smaller, you're going to buy more shares. So when volatility is greater, you should be buying a smaller amount of shares because volatility is greater. Makes sense? So $50,000, 1%, $500, $500 divided by the value of the 2 ATR, that's the proper amount of shares to buy. So that's first step. How many shares do I buy? The second step is I need to place my emergency stop. Well, what's my emergency stop? It's exactly the value of the 2 ATR that I just mentioned. So I take my entry price minus the value of the 2 ATR. That becomes my emergency stop. So remember now, because I bought here at 217.40, if I have 78 shares and it goes down $6.43, I've lost $500 because that's what I said at the beginning of the trade was going to be my maximum allowed loss. So I take my entry price minus whatever the value of the 2 ATR was that I used in the equation, place my emergency stop 2 ATRs below. Now, the good news is, if you have a loss, only 5% of the time, in my experience, am I going to hit my emergency stop. Only 5%. The other 95% of the time, if I hit my emergency stop, it is going to be because my end of stop hit. And my end of bar stop would be simply a close below the 200-day moving average, because that's ultimately why I took the trade, right? The intraday rejection of the 200-day moving average plus the V1. So there's your entry signal, position size correctly, place my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 200-day moving average. So as soon as I'm entered, I know where my my emergency stop is, my end of bar stop. The next thing I do is I look at the value of the 1.5. The 1.5 is now $4.82. So it's a little different back when I bought it here. But what I do is I take my entry price, see what the 1.5 is, and I place that 1.5 value above my entry. And this is the orange line. So what's that line? This is my trailing stop level. So if it moves 1.5 ATRs from my entry, then I go into what is called trailing stop mode. Now, when I get to trailing stop mode, it doesn't mean I do anything. It just means I'm in trailing stop mode, which means in the future, after I get to trailing stop mode, if I have a close below a previous bar's low after reaching trailing stop level, then I will exit half. This is a way of tightening up your stop by reducing half of your position size. Okay, so let's take a look again. Intraday rejection of the 200-day moving average plus the V1 entered at 217.40. Position size correctly based upon how I just showed you. Place my emergency stop 2 ATRs below my end of our stop, simply a close below the 200. I put my 1.5 ATR trailing stop level 1.5 ATRs above my entry, and that's it. So everything we've done so far has been defensive. We've position sized correctly based upon volatility. We have our emergency stop. We have our end of bar stop. We know where our trailing stop level. These are all defensive moves. Now I want to add some offense to it, to this trade. And the offense is taking partial profits if it moves a certain amount the following day. So I'll show you exactly how I do that. This, because I'm in this trade, I'll show you how I do this for Monday. So what I do is I take the closing price of whatever market that I'm in. Right now it's 225.97, and I look for the value of the 0.45 ATR. Right now the value of the 0.45 ATR is $1.45. So I do this every day. It changes every day. 225.97 plus 145. My first profit target for Monday is 227.42. That's my first profit target. Then I take my first profit target, 227.42. I add the value of the 0.45 to it again, plus 1.45. My second profit target for Monday is 228.87. I do it one more time. Take the second profit target, 228.87 plus 1.45. Excuse me. My third profit target for Monday or Tuesday, because Monday's a holiday, excuse me. So my third profit target is $230.32. So I place 3 profit targets every day by taking the closing price, adding the 0.45 to it 3 times. And I put limit orders into the system. And if I get to those limit orders, the question is, how much do I take off? I take off 10% at each profit target of however many shares I went into the day with. So I went into the day with 90 shares. I would take off 9, 9, and 9. 9 at 3 different levels that I showed you. And so this is a way of selling into strength, right? I want to play both offensive and defense in my trading. The stops, trailing stop levels, all that, defensive. Taking partial profits, offensive. And I really think it balances out my trading. There's a lot of advantages of taking profits. It reduces your position size, so it goes up and up and up. You're reducing your position size so that if you do get a big move back down, it mitigates the loss or helps you keep more profit. And I'll show you some good examples of that today. Okay, yeah, so that's the trade. So let's start off. Intraday rejection of the 200-day plus the V1. Next day moves up, hit some profit targets. Next day moved up again, hit several profit targets. So I'm taking our profits into the move up. Also got to trailing stop level, the orange line. Now I'm in trailing stop mode. So that means in the future, if I have a close below previous bar's low, I'm going to get out of half. So we had sideways motion, another profit target here, another nice big up day here, 2 profit targets. We're in trailing stop mode, by the way. And then here on the 27th of January was our first close below a previous bar's low after reaching trailing stop level. What did I do? I took off half of the remaining shares that I had for a gain of 4.35. Then we had a couple days sideways. We moved up again, took more profit targets. Then we had a couple days down, certainly didn't take any profit targets there, but then we had a couple days up, profit target, and now we moved back down again, and then Thursday took another profit target. And so the remaining shares that I have right now on this particular trade up 3.84%. So going forward, if it keeps moving up, I will continue to take partial profits. If we get up to a 65 RSI level, then I have another rule that comes into play where if I have a close below the 5 EMA, I will completely exit the trade. If we get up into the 70 RSI range and reject the 70 RSI, then I'm going to take off half of the remaining shares that I have. And then if I have a close below a previous bar's low after that, I'm completely out of the trade. On the other hand, if we just come down, straight down, and we close below the 200-day moving average, what am I going to do? I'm simply going to get out of the trade. So I know exactly what I'm going to do in this trade, regardless of what happens. Regardless of what happens, I have a plan. And that's what you need to do too. You need to have a plan. You know, I teach the deep dip buy in my one-on-one lessons. I teach the deep dip buy in my online course that I have for the deep dip buy, which you can find the link in the description below. It's on udemy.com. I've sold so many of them around the world. It's a really, really great place to get started if you want to take an online course. It's 9.5 hours video for this particular course, and I think you really enjoy it. But all the rules, you'll learn all the rules and so forth. So anyway, that link's there in case you're interested in learning deep dip buy, just rule by rule, exact. So pretty good trade so far on IWM, up 3.84%. Okay, let's get to the next trade. NVIDIA. Okay, well, NVIDIA has been a great trade, also a deep dip buy, by the way. I entered NVIDIA here on the 3rd of February at $117.10. Why? Well, remember, deep dip buy. 200-day moving average, 250, 300. On the day that I entered NVIDIA, during the day, we rejected the 250-day moving average, closed back above it. Also rejected the negative third ATR channel, which is another component. That's the confluence. The confluence of the trade was a rejection of the 250-day and also a rejection of the negative third ATR channel. So I got long here with a deep dip buy at 117.10. Position sized correctly based upon how I showed you before. I placed my emergency stop 2 ATRs below, and I placed my end of bar stop with a close below the 250-day moving average. So the key here in trading is to get your buy at support and have a good risk to reward ratio. Yeah, this trade has really taken off for me. I'm very grateful. But look, if the next day it closed below the 250, what would I have done? I would have just gotten out with a small loss, right? That's what risk to reward is about. Looking for key levels that get rejected, taking your position. If they close back below, quickly getting out for a small loss. And if, sometimes you're going to get a big gain like this, like I had, but it was very simple trade, just a simple deep buy rejection of the 250-day moving average. So I got long here, 117.10. I placed my trailing stop level 1.5 ATRs above, and next day we moved up, hit some profit target. Next day, moved up again, hit a profit target. Next day, moved up again, hit a profit target. Next day, moved up again, didn't hit a profit target, but got to trailing stop level. So now that means in the future, if I have a close below a previous bar's low, I'm going to get out of half. Hasn't happened yet. Next day, up again, profit targets, couple sideways motion. Thursday, up again. Friday, up again and hit another profit target. So this trade is doing very, very well, and it was a very simple trade, up 15.96% in a couple weeks. It's a monster trade, but the key is I was risking a little to make a lot, and in this particular case, I made a lot. So very grateful for the deep dip buy on NVIDIA. And so, yeah, those are the only two open daily swing trades that I have. IWM, remaining shares up 3.84%. NVIDIA up 15.96%. Okay, let's go to the closed trades and see what's happening on here on those. Intel had a huge trade on Intel this week, and let's just start first of all. This is not a deep dip buy. This is what's called a bullish order block. And if you've been watching this channel, you've heard me talk about order blocks for a long time, since last year. So I bought this on the 10th of February at 1976. But let's zoom out and take a look at why. You can see this green box here. This is the buyable area. Why is it a buyable area? Because all the way back here on the 7th of August, we had a down bar, and then we had a break of structure above a pivot point here, changing the structure of the company from bearish to bullish. And I have traded this 1, 2, 3 times. So when you're in a downtrend and then you break structure to the upside, every time you come back into the green box, into the bullish order block, it's a potential buyable area. And you can see I bought here, I bought here, and I bought here, and every time it went up. So on to this particular trade. I talked about this last week on Intel. If we come back into the bullish order block, the green area, and I have a signal, I will get in. Well, I got in on the 10th of February. Why? 1, because we're in the order block. 2, because we had what is called a higher low V2. What's a V2? A V2 consists of 3 bars. Bar 1, bar 2, bar 3. Bar 2 goes below bar 1's low, bar 3 closes above bar 1's close. So if you want to learn more about V1s, V2s, just go to my YouTube channel in the lessons playlist, and I have a whole video about V1s and V2s. I use them all the time. So the confluence of signals here, 1, mainly, is that we are inside the bullish order block. This is the buyable area. Look here, boom, up, boom, up. But I combine these. 1, we're in the bullish order block, and 2, my real entry signal was the V2. So I entered at 1976. I placed my emergency stop 2 ATRs below. My end of bar stops closed below the low of the order block here at 1907. I placed my trailing stop level 1.5 ATRs above, and I entered at 1976. You can see the next day was a monster up day. I hit, I think, 4 profit targets. I only put 3 profit targets in, but if I take out the third one, then I add more ones in manually. So the very next day had a huge move up, took the 4 profit targets in trailing stop mode. The next day, up again. I believe I hit 3 profit targets again here. So I'm reducing my position size. Thursday, up again. I think I hit 5 profit targets on this particular day. And then Friday, look at this. We opened up substantially higher and went higher. And I hit 3 profit targets again. No, I think it was 2 profit targets again. And then we had a big reversal. Make sense? So on this particular day, I exited the trade because we rejected the 200-day moving average. We rejected the 70 RSI. And so I just went ahead and locked in the gains on the trade. But look at this, 1, 2, 3, 4-day trade with a gain of 16.23%. And these setups don't always work this well like this. Sometimes they do, sometimes they don't. But the key is, don't focus on the profit. The key is be patient, wait for the setups, and give yourself a good risk to reward ratio. And if you're wrong, you can be wrong small. And if you're right, you can have some potential big trades like I've just shown you on Intel here and also on NVIDIA. So that is Intel. It is closed, was closed for a gain of 16.23%. Okay, here we go, India. Now, India was a loss. Not every trade I have is a win, but this one, this has been kind of a frustrating trade, I'll be honest with you. I got in the trade back here on the 21st of January. Why? Well, if you look to the left here, you see this bar with the green highlight. This is called a bullish abandoned baby. And I love abandoned babies. I love island reversals. They're very similar. If you want to learn more about them, go to my YouTube channel. But in this case, an abandoned baby was we gapped down. You can see we gapped down. So the sentiment was very bearish overnight. However, the very next day, boom, we gap up. So we went from very bearish sentiment-wise to very bullish sentiment-wise in a very short amount of time. When this happens, over 70% of the time, when you look out into the future, you will be higher. 70% of the time. 30% of the time, you'll be lower. And we were lower on this particular one. But if something, if you have some price action where something happens, and from your experience, 70% of the time something's higher, well, I'm going to go ahead and take that trade. And I did take that trade. So I didn't buy the abandoned baby when it formed. I waited for the price to come back to the top of the abandoned baby, and I bought here at $50.83. Now, when I enter an abandoned baby, I don't scale out of my profits like I just showed you on the deep dip buy and the order blocks. I do one very simple thing. I place a 2 ATR stop and I place a 4 ATR profit target and I just let it go. One of two things is going to happen. One, I'm going to hit my 2 ATR stop and lose 1% of my account, or I'm going to hit my profit target and make 2%. And this particular one, unfortunately, on Wednesday, I hit my 1% profit target. And so I did take a loss on this particular trade. Of 2.07%. But I'm going to circle back to INDA to show you, because I'm looking to re-enter this trade again if I get a legitimate signal. And when we get to the potential trades for next week, I'll go over exactly why. But again, I took the trade because we had an abandoned baby. The price came back to the top of the abandoned baby. Placed my emergency stop 2 ATRs below, my profit target 4 ATRs above, and it just never worked. Came down, almost got my 2 ATR profit target. Then we went up nicely. Things were looking better, and then down. And then I got out on Wednesday, and then we jumped up again on Thursday. I was like, oh, shoot, I sold the bottom. But look what happened on Friday. So I'm glad I got out when I did. But again, I'm going to circle back to this at the end of the podcast about why I'm looking to enter this trade. But yes, this was a loss of 2.07%. And then Caterpillar was also a loser as well. I took Caterpillar here on the 4th of February. The confluence, nice confluence of signals. We had a bullish order block, lowest bar closed before we changed structure. Then we had a pullback. So this is a combination between a deep dip buy and a rejection of the order block. I thought this trade was going to go, but it didn't. But I got in here at 361.70. My end of bar stop was simply a close below this halfway of this big up bar of 354.80, and then on Wednesday it did close below there. So this particular trade was a loss of 2.79%. But I am going to revisit this at the end of the podcast, and I'm going to look for another possible entry in there. And so there we go. The three closed trades: Intel gain of 16.23, INDA a loss of 2.07, and Caterpillar a loss of 2.79. So not all winning trades, but you can see generally the winning trades are going to be much larger than the losing trades, and in these examples here, it's exactly what it was. Okay, so I also like to trade the weekly bars. Let's head over to the weekly trades, the weekly open trades that I have. Weekly bars close on Friday, so I make my decision on Friday. And I did enter bonds TLT on the 17th of January at $87.20. Why did I enter? Well, here we have an order block, right? The green box. So whenever things get into the green box, I'm looking for a potential entry. In addition to that, we have what is called a V1. I've covered these a little bit today. Bar 1, bar 2 goes under bar 1's low, closes above bar 1's close. So the confluence was we had a V1 and we had a rejection of the bullish order block. Got long, 87.20, placed my emergency stop 2 ATRs below me, placed my trailing stop 1.5 ATRs above, and we are up. We have not got to trailing stop level yet. I did take one profit target, not last week, but the week before. But, bonds are kind of slow moving, and weekly bars are certainly slow moving. But happy with the trade so far. Nothing too exciting, up 2.19%, but it is working my way. But the key here is if I get to trailing stop level, then I go into trailing stop mode. So that's the key. So not super exciting, but a nice little gain of 2.13%. And then last but not least is DDM on the weekly. DDM is double leverage Dow. This is a short position, just almost dead even on this particular trade. But let's talk about why I took the trade. Well, this is an order block, but it's a bearish order block. That's why the bar is red. Here is your highest up bar close before we change market structure to the downside. Whenever I change market structure to the downside, I look for the highest close. That's my order block. And generally what will happen is you will get a rally back up to that order block and fail. That's exactly what happened. So when I took this on the 31st of January, I rejected the bottom of the order block. I got short at 103.70. I placed my emergency stop 2 ATRs above. You can see it up there at the top. My end of bar stop, simply a close above the high of the order block. My 1.5 ATR trailing stop level is down here. But look, I got long at 103.70. It's 103.77. So I'm down 0.01%, whatever. We'll just call it even for now. But I like the trade. But the key is when you are in an uptrend and you break structure to the downside, I don't want to short there. I want to wait for a check back. I want to wait for a counter rally because now I view this as a bear. So if I'm bearish, I want to short the rallies. If I'm bullish, I want to buy the dips. So as soon as we change market structure to the downside now I'm looking to short the rallies, and I'm keying off the bottom or the top of that order block. In this case, it rejected the bottom of the order block, so that's why I got short. So we'll see what happens with next week. Now, because this is a short position, just back to our taking partial profits, how am I going to set my profit targets for next week? Well, 103.77 minus 222, the 0.45. That's my first profit target. Then the first profit target minus 2.22 is my second, and then we do it again for the third. And then if we get into trailing, or if I get into trailing stop mode, if it goes down enough for me to get into trailing stop mode, then I'm going to get out of half if I have a close back above. Makes sense? So anyway, I hope these positions that I just went through were are helpful for you. If you have any questions, let me know. And at this time, let's head over, talk a little bit about trading psychology, and then after that, we will get into the potential trades for next week. So this is for my good friend Steve Burns. You can check out Steve Burns at @SJosephBurns on Twitter. He's a great author. He's a great trading coach. He's a great mentor. You can take a look at all of his books on Amazon.com, but I would highly recommend reading his books. I have read all of them, and I have learned a lot. So let's see what Steve has to say. Michael Jordan's total shooting percentage was only 49.7% for his career. Quit thinking every one of your trades will be a winner. So he basically made less than half of every shot that he took, but one of the greatest basketball players of all time, right? So how does this relate to trading? Well, just like Steve says, quit thinking every one of your trades is going to be a winner. You know, I know people that make a lot of money with a 35% winning percentage. If somebody says, "Oh, I've got a trading approach, 97% wins." Well, be careful because it's not winning a lot, and when it loses, it's probably going to lose a lot. So losing is just part of the game. It's your cost of doing business in trading, everyone. I don't sweat it when I have a loss. I have losses all the time. The only takeaway, the key takeaway is that yes, you're going to have losses. They are inevitable, but you have to keep them small, and you have to allow yourself the opportunity setting up, structuring the trade so that if you're wrong, you can bring wrongs small, and if you're right, you can have big outsized gains. Make sense? That's really, really what it is. And most traders do the opposite. They let their losers just grow and grow and grow, and when they have a winner, they just go ahead and take them. That's exactly opposite of what you need to do. You need to be very impatient with your losers, and you need to be very patient with your winners. And you're going to have winners, and you're going to have losers, and you're going to have winners, and you're going to have losers. That's just part of trading. So if you have losers, don't think you're a bad trader. You're only a bad trader if you're not following your rules and keeping those losses small. That's it. So thank you, Steve. Hope that was helpful for you. And now let's get on to potential trades for next week. Okay, so what I'm going to show you are the potential trades that I'm looking for next week, both on the dailies and the weeklies. You can see here on the dailies, I have highlighted 6 potential trades next week, if and only if they get to where I want them to get to. If they don't, I'm not going to take any of them. However, it's potential. There's a potential that all 6 could be triggered on the same day. So does that mean that I would take all 6 trades? No. I only take 1 trade per day per time frame. And I allocate a score to each particular trade. So if they have 1 entry signal, they get a score of 1. If they have 2 entry signals, they get a score of 2 and 3 and 4 and so on. And so I'm going to pick the trade that has the highest quality score. And the way that I do that is I factor in how many entry signals were there, what's the risk to reward ratio, how does it look on higher time frames, are there also some supports, or also some potential triggers on the higher time frame, and what's the relative strength of this particular market, which means that maybe the market's down, but one particular stock is up on that day. Well, I'm going to score that one higher. And that's what I teach my students to do. And by the way, I do teach private one-on-one lessons in the evening time via Skype. I teach a 15-hour course where I teach my students all 7 of the different trading approaches that I use. I take them through step by step everything that you need to learn so that you'll have these 7 different trading strategies that you can use for the rest of your life. I've been trading almost 30 years now, and I have been through every single type of market, up, down, sideways, market crashes, market melt-ups, everything. And so I'm a good teacher. I've taught so many students around the world, both from absolute beginners all the way up to the hedge fund level. So if you're interested and you want to take this one-on-one course with me, just send me an email My email is in the link in the description. We'll have a Skype call. It's not a sales call. It's just a call for me to get to know you better, learn more about your challenges, your goals, what you want to do with trading. It's a good time for you to ask me any particular questions about the course. And then we're done with the call. That's it. And if you're interested after that, you just need to call me back and say, yeah, I like what we talked about. Let's schedule the calls. But you're going to learn a lot. It's worth every penny. I promise you, everyone. And I hope you call, and I look forward to teaching you. So let's get started here on Caterpillar. Okay, well, I just got out of Caterpillar, right, for a loss of 2.79%. Do I want to get back in? Well, I kind of do, and I'll tell you the reason why. You know, I got in here on the 4th because we bounced at the 200-day moving average and we bounced off the top of the order block. So but it didn't work, right? But we are still inside this bullish order block. So this is still a buyable area. So this is what I'm looking for going forward. First of all, if we come down to the bottom of the order block, the bottom of the green box at 348.52, so in other words, if we came down, poked our head underneath it, closed back above, that would be a potential entry point for me. However, if we go lower, look, here's the 300-day moving average down here. Maybe that's where the buyers are going to come in. So I'm looking for a rejection of the low of the order block at 348.52, down, up, showing me that there are no more sellers underneath here. And plus, that would give me a very, very good risk to reward ratio. Or if we go lower, rejection of the 300-day moving average, deep dip buy to the downside. So currently, that is what I'm looking for. Rejection of the bottom of the order block or lower rejection of the 300-day moving average. Let's go on to Google, Googl. Okay, well, Google's had a kind of a rough time of it lately. Has not participated in this rally. But from a deep dip buy perspective, you have all the bigs below you. You have the 200-day moving average, you have the 250-day moving average, and you have the 300-day moving average. And if you got down to the 200 or the 250, you would also be in the 30 RSI range. One of the best potential setups there is, especially on a big monster stock like Google, is the confluence of an under 30, over 30. At the same time, you have a rejection of a major moving average like the 200, 250, or 300. So my guess is that if we got down, depending how long it takes us, if we get down to the 200-day moving average, very likely at the same time, we will be at a 30 RSI. And if you go back in time and you buy an under 30, over 30, at the same time you reject a major moving average like the 200, 250, or the 300, I'm sure the results would be amazing because it doesn't happen that often on big stocks like this. So that's what I'm looking for. So just more specifically, next week I'm looking for a rejection of the 200-day moving average, some type of rejection of the 250 or the 300-day moving average. That's what I'm looking for on Google. INDA, okay, also went over this. And I did get stopped out on this with the bullish abandoned baby on Wednesday. But honestly, big picture, this is my favorite potential setup. Now let me explain why. I know this looks hugely bearish, but when you look at the divergences of what's going on here, you'll see why I look at it as bullish. So I studied one-on-one with Dr. Alexander Elder, and his favorite trading setup is what's called a double bottom bullish divergence, bullish MACD divergence. Here, these red bars, these are MACD bars. And the lower you go and the lower these bars go, the higher the momentum to the downside. But look what happened. We had this big move down, very deep bars. Then we rallied into some green. Now look, we are lower here than we are here or here. But even though we are lower, you see how we don't have any red bars whatsoever. This is his absolute favorite setup. Double bottom, bullish MACD divergence with a missing right shoulder. And the added benefit of the missing right shoulder is, look, this is the left shoulder. There's no right shoulder of red. So this is hugely bullish, even though it looks hugely bearish, because From a MACD perspective, we are running out of momentum. We are running out of selling momentum. And if you run out of selling momentum, you're running out of sellers. And if you run out of sellers, the implication is you're going to move up. And it's true. When you run out of sellers, that's when you go up. When you run out of buyers, simply that's when you go down. So we have a double bottom bullish MACD divergence. We have an ATR divergence, a huge ATR divergence. Look, here are the ATR lines: negative third, negative fourth, negative fifth, negative sixth. At this point, we're down like negative 10. Well, look, we are lower here, and we're only to the negative 5. This is huge. Let's look at the RSI. Look at the RSI down here. At this low, very deep. Now we're much lower than here. The RSI is still above 30 RSI. So taking all these divergences, the MACD divergence, the RSI divergence, the ATR divergence, this is a scream to me that look for me to get long this particular market. But the key is, just because you have all these divergences doesn't mean you just hop in. You need a signal first. So a signal could be another bullish abandoned baby. That would be one. We're at 34.75 RSI, so another signal if we go lower is rejection of the 30 RSI. Maybe it's a higher low V1 or V2, but I'm watching this like a hawk. It's been a while since I've seen divergences like this. But again, the divergences are hugely bullish, but I need an entry signal first to get into the trade. The easiest one right off the bat is an under 30, over 30, or a bullish abandoned baby, or a bullish island reversal. So watch this one. I think in the future, this is going to be higher. But again, I could be wrong. I have to look for the signals, and I have to follow my rules because I could be wrong. But this looks extremely bullish to me. Okay, let's go to the Qs. Okay, well, the Qs, big rally up. I'm looking to short. Why? Well, look, here we have the red box. This is the order block before we change market structure to the downside. So the high of the order block back on the 16th was 539.15. We are currently at 538.16. So these are on the daily. Next week, if we pop our head above the high of 539.15 and close back below, very likely I will get short. Doesn't mean I'm going to be right. No. All it means is my risk to reward ratio is very good. If it goes down, okay, fine. The trade's good. If it goes up and closes above that order block, then I'm simply out for a very small loss. But that's the key. Be patient, wait for a legitimate setup, enter the position. If you're right, you have the potential to be right big. If you're wrong, maybe you're wrong 1/4% or 1% or 2%, but you have the ability to make 3 or 4 or 5 or 6 to the downside. So we're coming up, testing the high of this order block, so that's what I'm looking for. But it has not happened yet. Again, I'm looking for a rejection of 539.15. Let's go to oil, USO. Okay, well, you see a green box there. That means I'm looking to buy. This is a deep dip buy. Here's the 200-day moving average. We had this huge run up in oil. Now we've had this huge pullback in oil. I'm looking for a rejection of the black line, the 200-day moving average, deep dip buy. In addition to that, back on the 31st of January, we had the golden cross, which means the 50-day moving average crossed over the 200-day moving average. When this happens, after that, the first pullback to the 200-day moving average is generally a very good entry point. So that's the confluence there. Rejection of the 200-day moving average, and the added confluence is that we had the golden cross previous to that. So that's what I'm looking for there. And then last but not least is the dollar. You can see the dollar really has got hit hard. But when I look at this again, we have divergences, just like I showed you on INDA. Look, we're low, lower, lower. MACD is low here. Here we're lower, but it's not as deep. And here we're lower again. It's not as deep. This is called a triple divergence. There's also ATR divergences. Here we're at the -6 ATR channel. Here, even though we're lower, only at the -2 ATR channel. And same with RSI. At this low here, RSI was deeper. Now we're lower here, not as deep. So divergences lining up all over the place, but I still need an entry signal. What could the entry signal be? Couple things. Simply, if we go lower, rejection of the 200-day moving average would do it. Alternatively, if we gap up on Monday, then that would give me the bullish abandoned baby. So those are the dailies. Let's head over to the weeklies. Look at those. AMD. I've been tracking AMD for a long time, everyone. Well, you see the green box on AMD. That means I'm looking to buy. Here we have an order block on the weekly all the way back October 27th. The high, 102.42. The low, 93.11. I am looking for AMD to come down, reject the high of the order block. That would be one entry point. The second entry point, look, here's the 300 weekly moving average inside of the order block. That would be fantastic. Or last but not least, if we go even lower, reject the bottom of the order block. So rejection of the top of the order block at about 104.20, rejection of the 300 moving average on the weekly, or a rejection of the bottom of the order block about 92.60 there. So somewhere in this range is really where I'm looking. And I went into AMD and I looked, I just wanted to check the options market to sell some options, to sell some puts down at these levels. And when I looked at what they were paying in premium, it is so little. What does that tell you? That tells you that the options market does not believe that it's very likely we're going to go down here or stay down here very long. So I like to look at the options market too to see what they're telling me. If I was getting paid a ton of money to sell puts here, that would make me a little more concerned about taking the trade. But they hardly pay anything, which is telling me the market really is not concerned about the market staying this low for too long. So that's what I'm looking for. Rejection of the high of the order block, about 104.60, the 300 weekly moving, or the 300 weekly moving average, or the bottom at 92.60. Gold. All right, so gold's had this tremendous run up. This is the first basically bearish bar that we've had on gold for weeks, and it was still up. Why is it bearish? Well, because it closed below its open. What I am specifically looking for on gold next week is if it gaps down from Friday's close. You can see, here's the close, 266.29. If we gap down on Tuesday, now it becomes a bearish abandoned baby. So at that point, I would short. And how would I set that up? 2 ATR stop to the upside, 4 ATR profit target to the downside. But the key is we have to gap down. You can see 2 weeks ago we gapped up. Now I'm looking for a gap down. That would make it a bearish abandoned baby. Lockheed Martin, LMT. Wow. Straight up, straight down. But we are straight down into some important levels. What's the important level? Well, a hugely important level. Here's the 200 week moving average. We close below it. And look at the RSI, 29.97. Remember, I was just talking about the confluence of rejecting the 200-day moving average at the same time we reject the 30 RSI. So next week, if we close above this 200-week moving average, we will also certainly close above the 30 RSI, and that is a strong signal. So I'm going to be watching LMT very closely. Conversely, if it goes down lower, here's the 250-week moving average, here's the 300-week moving average. So really, I'm very interested in Lockheed Martin at this time. I mean, just obviously, we've had a huge move down, but we are getting into some bounceable areas. But just because it's low doesn't mean I just want to buy it. I need the price signals to tell me something. And so the first one would be a close back above the 200-week moving average, which would also put us back a close 30 RSI. Merck looks like Lockheed Martin. My gosh. Well, Merck, we are in an order block from way back in 2022. These things have memories. If we would have closed back above the high of that order block on Friday, I may have bought this. The high is 83.45. The low is 79.48. I'm looking to get long Merck. I mean, we're way oversold. We're in a long-term bullish order block. Two things have to happen. Either one, we close above the order block right there of 82.90, 82.90, is that right? 83.60, and the low 79.74. Somewhere in this range. It just needs to close above the high of that green or close below. That's it. Last but not least, Pfizer, bullish order block. Here you go. Here's the high and the low of the order block. The high is 24.94. The low is 23.71. We changed market structure to the upside. Last time we came down in the green box, we bounced. And now we're coming back down again. Are we going to get there? I don't know. But if we reject the high of the order block here at 24.98, I consider good long there. Or if we go lower, reject the bottom of the order block, 23.73, that would also be a potential place to get long as well. So I hope you found this helpful, everyone. If you did, I appreciate if you could hit the thumbs up button. Like I said, leaving tonight back to the States, it's been nice to be able to be here in Colombia with my girlfriend and my dog and create this content for you. And like I said, hope it's helpful. Hope you try to go out and do something nice for somebody today. If you could try to go out and do something nice for an animal, that would be great as well. If I can help you with your trading, love to have you as a student of mine. Just send me an email. Back in Utah, good time for me to start teaching again. I have the Udemy course for the deep dip buy if that's of interest. The link's there as well. But I hope you enjoy the rest of your weekend, everybody. Please be careful, as always, next week with your trading. And God willing, I will see you next week from Utah. If you have any comments or questions about anything I said or went over, just put them in the comment section, and I'll do my best to get back to you. Thanks a lot, everyone, and we'll talk to you next week, hopefully. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.